I've always wondered myself, why do we have to hear this every night, what the stock market is doing?
70 record closing highs so far for the Dow.
Investing for beginners. How to get started, what's the best way to get started, and what advice do I have for people that are brand new?
Investing for absolute beginners. How to invest only $100. The biggest misconception about investing is that it's reserved for the rich. That might have been true in the past, but that barrier to entry is gone today, knocked down by companies and services that have made it their mission to make investment options available for everyone, including beginners and those who have just small amounts of money to put to work. By investing, you can better combat inflation, increasing your chances of being able to afford the same amount of goods and services in the future that you can today. That's why in this video, we will show you investment tactics for absolute beginners with as little as $100. Have you ever tried investing before? Let us know in the comments section below. Let's get right to it. Investing in the stock market is often an expensive endeavor. Individual stocks can cost hundreds or even thousands of dollars each, and you can easily spend tens of thousands of dollars building a portfolio. Unfortunately, many people simply don't have that kind of cash to invest. However, a stock market is still a fantastic tool for building wealth, so it's wise to consider investing even if you don't have much money to spare. And with thoughtful strategies, you can get started in the stock market with just $100 or less. Investing is a way to set aside money while you're busy with life and have that money work for you so that you can fully reap the rewards of your labor in the future. Investing is a means to a happier ending. Legendary investor Warren Buffett defines investing as the process of laying out money now to receive more money in the future. The goal of investing is to put your money to work in one or more types of investment vehicles in the hopes of growing it over time. Here are some of the best investment tips for beginners. Number 1. Open an individual retirement account. An IRA is an individual retirement account that allows you to save money for retirement and has various tax advantages. Whether you're enrolled in an employer-sponsored retirement plan or not, an IRA is a great way to bulk up your retirement savings, something crucial for all of us, especially given that most people have little or no money in their retirement savings right now. So opening an IRA is an essential part of breaking that cycle. The two common types of IRA are a traditional IRA and a Roth IRA. A traditional IRA has tax-deferred benefits. This means the money you contribute is pre-taxed. You'll not be taxed on this money until you withdraw it in the future. In a Roth IRA, you pay taxes on the contributed amount, but you will not be taxed on withdrawals when you retire. In America, for example, the annual contribution limit for 2021 is $6,000, unless you're over 50. Then you can contribute up to $7,000. No matter which you choose, an IRA is an excellent way to start investing with $100. Number 2. Buy savings bonds. Learning to buy bonds is an essential part of your education as an investor. A well-diversified investment portfolio should strike a balance between equities and fixed income, letting you ride out volatility while capturing growth along the way. Bonds tend to offer a reliable cash flow, which makes them an excellent investment option for income investors. A well-diversified bond portfolio can provide predictable returns with less volatility than equities and a better yield than money market funds. Even when interest rates are low, bond investing options like high-yield debt or emerging market bonds can meet an investor's need for income, although with substantially more risk. Savings bonds can be a safe investment for those who are risk-averse. You can purchase a savings bond at face value and earn interest when it matures. Bonds can be cashed in at any time, but the longer you wait, the more valuable a bond gets. Some bonds may double in value by their maturity date. The two types of savings bonds are I-savings bonds and EE savings bonds. Each has advantages and disadvantages. For example, I-savings bonds earn money during high inflation, but you aren't guaranteed to double your investment like with EE savings bonds. Number 3. Start an emergency fund. It's understandable if your first thought was to start by taking your $100 and buying stocks, cryptocurrencies, or some other investment that could double, triple, or even increase your money tenfold. After all, the stock market has proven itself to be the simplest and most accessible way for people to build their wealth over time. Many cryptocurrencies have gained enormously in value over the past few years, but those assets are also volatile. They can fall in value very sharply with little or no warning, and often without a clear reason why. That's not a big deal if you're able to buy and hold, and so long as you own a diversified mix of investments where your winners can make up for a few losers. Time in the market will help you create wealth. But what if you can't hold those investments through a crash and have to sell because you need the money? A little bad luck and timing could mean your $100 investment is now worth $80 or $50 or even less. That's why starting with money and savings is far more important than choosing investments that can be really volatile. Imagine if you were to lose your job or suffer an unexpected illness or accident that affected your income for weeks or even months. Having several months' worth of income available in cash can mean keeping life's unexpected events from damaging your financial plans. Interest rates on savings accounts aren't very high, but this is about protecting your downside, not capturing high returns. Number 4. Use a micro-investment app or Robo-Advisor. Once you have financial emergencies covered, you're in a much better position to start investing. If you like a fully automated approach that requires as little effort as possible, then a Robo-Advisor may be just what you're looking for. Robo-Advisors use apps or websites to learn about your financial needs and then come up with an investment strategy to meet them. They'll often use basic information such as age, family size, income, and risk tolerance to tailor a portfolio to your needs. Robo-Advisors then handle all the details of selecting investments, making purchases and sales, and keeping you informed. You could also use a micro-investing app, which allows investors to put small amounts of money to work over time. For example, a micro-investing app might allow you to round up your credit card purchases to the nearest dollar and invest the difference, while also allowing you to deposit funds when you have extra money, like $100 to invest. They're a great way for beginners to get started investing because they often require very little money and they do most of the work for you. That's not to say you shouldn't keep an eye on your account. This is your money. You never want to be completely hands-off, but a robo-advisor will do the heavy lifting. And if you're interested in learning how to invest, but you need a little help getting up to speed, robo-advisors can help there too. It's useful to see how the service constructs a portfolio and what investments are used. Some services also offer educational content and tools. A few even allow you to customize your portfolio to a degree if you wish to experiment a bit in the future. Number 5. Invest in stock index mutual fund or exchange traded fund. Stocks are probably the most powerful wealth building tool that the average person can buy. However, it can be tough to pick the winners. And if you're only investing $100 or even less at a time, it might not be worth the time and effort to choose individual stocks. This is where stock index funds come in. When you invest in a stock index fund, you buy a piece of every company that's held in that index. In other words, if you invest $100 in the S&P 500 ETF trust, you'll own a tiny portion of all 500 plus companies that are in the S&P 500 index. You get instant diversification and an investment with a long history of making money for anyone who can hold for a decade or longer. It's also simple to do so. You just put your money into a stock index mutual fund or a low-cost exchange-traded fund. You can choose from a wide variety of stock indexes, ranging from popular ones such as the S&P 500 index to more specialized indexes. There are some differences between ETFs and mutual funds, including how you buy and sell shares, what minimum investments apply, and what fee you can expect to pay. But the general idea behind both ETFs and mutual funds is that you can invest in the whole market or selected parts of it through a single investment. Once you've built up a solid foundation in these index tracking funds, you can branch out and explore other investing options. But an index fund might well be all you'll ever really need in order to succeed with your investing. Number 6. Consider investing in fractional shares. Fractional shares are just like individual stocks, except you're only investing in a small portion of a single share. This is a great option for investors who want to invest in particular stocks but can't afford to buy full shares. In some cases, you can invest in a high-priced stock for just a few dollars. It's also easier to diversify your portfolio with fractional shares. When you're investing in individual stocks, aim to invest in at least 10 to 15 different stocks across various industries to limit your risk. If you're buying full shares that cost hundreds of dollars each, that adds up quickly. But when you're investing in fractional shares, you can build a robust portfolio for less than $100. However, one thing to consider is that not all brokerages offer this type of investment, and not all stocks are available as fractional shares. So if you have your mindset on a particular stock, be sure it's available before you begin building your portfolio. Investing in the stock market doesn't have to be expensive. By being strategic with your investments, you can get started investing even if you don't have much cash to spare. And the sooner you begin, the faster you'll start building wealth. Number 7. Try peer-to-peer lending. If you're afraid to start investing in the stock market with your $100, you could look at becoming a peer-to-peer lender on a site like Prosper or Lending Club. Peer-to-peer lending is just like it sounds. You lend your money to others, and they pay you back with interest. Peer-to-peer lending is great for borrowers with a small amount of money because you can break your investment into many small loans. If you're going to start investing with $100, you can lend as little as $25 per loan. That means your initial $100 could be invested into 4 different loans. Then, each month, these loans pay back your principal and interest, which you can then invest into other loans. Over time, your initial $100 could be loaned out to multiple loans beyond the original 4, and you will continue to see your growth compounded over time. But there is one way to avoid investing your $100. One trap to be aware of is investing in penny stocks. Penny stocks are typically low-priced stocks of smaller or thinly traded companies. While it may seem logical that small companies or stocks that trade for just pennies per share or even less have the highest return potential, the reality is that the world of penny stocks is full of fraudulent companies and pump-and-dump schemes. In short, if you're asking how to best invest $100 in penny stocks, the answer is don't. That would be all on our video about investing for absolute beginners, how to invest only $100. If you found it helpful and would like to see more, be sure to subscribe to our channel for more of our amazing content. Please give us a like, share the video, and don't forget to turn on the notification bell for timely updates of our latest uploads. We value your feedback. Feel free to share your thoughts with us in the comments section below.